Hi, I'm Harold Beavis, the President and CEO of Xerium Technologies. Thank you for joining today. Our company is on the New York Stock Exchange, and our trading symbol is XRM. I'd like to give you a quick overview of our company and then open it up for Q&A at the end. First, I'd just like to remind you that I'm going to make a few forward-looking statements today, and I'm going to make a few non-GAAP comments, and I have reconciliations in the back of the document. Just a quick introduction of myself. I've been at Xerium Technologies since 2012, and I'm also the director of another public company named Commercial Vehicle Group, a NASDAQ company. I have 31 years of experience, and this is my 15th year as a CEO. I'm experienced at strategic repositioning, and that is one of the key themes at Xerium Technologies, which I'll take you through in the presentation. I have done quite a bit of acquisitions, 11 of them, 3 sales as well, 11 new business startups, and 24 plant expansions, and 26 closures. Have some experience at growth and cost optimization. I've launched about 150 new products, and I'm also personally a Lean Six Sigma Green Belt. I am an owner of Xerium stock. I have 533,000 shares, and I recently purchased stock at $6.05 a share. Our company makes consumable parts and services, and we provide them for the manufacturing processes used by our customers. Our products, paper towels, napkins, cardboard, shipping containers, magazines, disposable diapers, disposable fabrics, and also fiber cement, siding, and roofing, which you can see here are conveyor belts, high-end conveyor belts called machine clothing, rolls, which we recover and roll through these machines, which I'll talk about in a minute. We have optimization analytics, a service that we provide to optimize the performance of these large machines, and we repair certain parts of these machines. If you look at our company at a glance, in 2016, we did $471 million in sales. Our EBITDA, which is earnings before interest, taxes, depreciation, and amortization, was $95 million, or 20% of sales, so we're very profitable. And we generated $23 million of free cash flow. We have about 3,000 employees, and they work out of 28 plants in 13 countries. And we direct sell our products through 400 salespeople to customers in 63 countries. We primarily do business in foreign currencies. About 70% of our sales are outside of the United States. We have 3 R&D centers, about 450 patents, and as I mentioned, we use data to drive our business through our processes. Our companies and factories are located in definitely global fabric. We have 10 machine clothing factories where we cover all of the customers in the world. We have 18 roll repair and mechanical services centers also located throughout the world, 13 countries as I mentioned, and as I also mentioned, 3,000 employees. We're building a new plant right now in Concepcion, Chile, as you can see on this graphic, and that will become our 29th facility. Our headquarters is in Raleigh, North Carolina. And now I want to take you through our business plan and then turn to our results. Our first strategic objective as a company is to achieve sustainable revenue growth. Our core value proposition to our customers is to improve their operating performance through the performance of our products. In our industry, most things net out to cost per ton. That's the lingo used in our customer world, and our products help them achieve higher output or higher quality per ton. Our goal has been to attach our company to naturally growing segments of the market and to deploy our successful recurring revenue model. Our business is very sticky. We tend to hold our business for up to a decade, and it's like an annuity when we secure positions on machines. Pursuit of this strategic objective has required us to reposition our capacity into the right types of products and in the right geographies. Key actions underway this year in 2017, we're rolling out a brand new product line for containerboard and cardboard machines, which is about half of the world market for what we do. And we're expanding our China operations and expanding capacity for certain new products. We have a goal to align ourselves to stable and growing segments of the market. In 2012, 2013, when I started, about 72% of our business was attached to the growing segments of the market. Now it's 79% and headed up. We have a goal to have a naturally growing company as a result of our actions. In products that are growing, consumer packaging, of course, with the whole internet, e-commerce dynamic, tissue, the boxes that our products come in, tissue converting, paper towels, napkins, shipping containers, folding cartons. These are products that are growing throughout the world, not just the United States, but throughout the world. And there are certain emerging countries that are growing and spending more on disposable consumer products. China, Southeast Asia, Chile in Latin America, and Turkey in the Middle East. Xerium is repositioning, that's for sure, and we're headed into growth markets. To do that, we had to have plants that were sources of equipment and plants that were the destinations for that equipment. And we had to close 8 plants. We did so, it's done. The plants were in Argentina, Brazil, Canada, Spain, North Carolina, France, Germany, Virginia, and we repositioned that equipment and repurposed it to make different products and mostly in different geographies. And you can see the destinations for the equipment. And we opened 2 new plants at the end of 2015, and they had their first years of service in 2016. That was a new plant in China and a new plant in Turkey. China's a big part of our growth story of the future, and it was the big reason for our above average spending during the 3-year period of 13 to 16. And I put some statistics here for you to view, but it was a big, important, strategic move by us to have a large machine clothing facility in the largest market in the world, and we completed that, as I mentioned. This is a picture of that new plant, and you can see that it's a modern plant, and you can see our employees in the graphic here. We had some fun one day when we made our 1,000th machine felt that we shipped. Our products cost up to $35,000 each, and they last for about 45 days each. So it is a consumable product, and it is the key operating part of the machine, and they are consumed while the machine is running. And this is a big advancement for us to have a competitive plant right in the middle of the largest market in the world. And you can see that we grew our sales about 50% already, and we're ramping up. Recently, we had a big milestone also where the second part of the factory began production. It is a 4-phase plan, and it covers several years, of course, and the second phase of this plan was forming fabric production. This is our most profitable and advanced product line. It's the very beginning of the machine. We opened it up with 20 orders with elite customers. In that area of the world, these are names that are well known: Nine Dragons and Asia Symbol. This would be equivalent in the United States to International Paper and Kimberly-Clark. These are big companies, big public companies that serve the Asian market. And in fact, we already have our first piece installed and running on a machine. Being competitive in China is a big deal, and it opens up sales for our entire portfolio. We had 2 rolls plants in China and had had them for some time, a couple decades, and having our first machine clothing plant in the region with local lead times is a big deal for us. We also have plans to open another rolls plant in southern China, and then we'll have the footprint the way we need it. And as I mentioned, we have the multiple phases of the machine clothing plant that will cover a few years. Also, there's new machines being installed. I want to mention that. You can see on the graphic here that 34% of the machines on the planet are in China already out of the 8,000. There's a lot of machines installed per year, several hundred, and the destination for them over the next 10 years will be centered in China. So it's the right place to be. Our business is stabilizing, therefore. In the prior few years, there was a lot of machine closures, primarily machines that were making newspaper, copy paper, directory grade, catalog papers, and they were declining mainly in the United States, Canada, and Western Europe. This is where the paper industry first started long ago. Some of these machines were 100 years old, literally, and they were closing. And you can see the graphic here. That started to run its course about the middle of 16. And we were having more losses than wins for a couple of years there. And this turned the corner last year. In about the middle of third quarter of last year, there's a lot of data on this industry. It's tracked. And already this year, year to date, you can see the graphic here. There's been about 300 new machines starts and restarts, and it's outpacing the closures now. And the third-party market researchers on the industry already estimate that the nadir of this whole dynamic was last year. So the market's definitely improving for us, and already we can see our sales stabilizing. Our sales were down about 1% last year as we were suffering from these closures and fighting back to fill up the new machines as we put them into place in our new plants and new locations, and our backlog is already up. We track a metric internally called new wins, and fundamentally, as we're putting these new machines into new locations and retooling them to make new products, we're tracking our fill rate to fill up the new machines. We've already won about $94 million in business in the last 3 years, and we've set a 2017 target to generate 60 million of new wins to fill up new capacity and already year to date, we're on track with that, achieving that objective. Evidence of success is backlog. Are you getting orders? Are you getting orders on your books? And our backlog began to increase at the end of last year, ended the year at a record, and is up and it's a great mix. It's machine clothing, which is a lot of the new positioning that we did. We generated 90 new products during that same time period. So as we moved these machines, we retooled them to make new products and implemented new designs. So we hit these new markets with new products to introduce and to make proposals for business on new machines. And we've been highly successful. And the graphic, as I mentioned, is new wins. In addition to achieving and pursuing growth, we obviously have to manage our cost structure. We have a lot of plants, 28, building our 29th, and we run them all with the same culture, and it's Lean Six Sigma. It's a big program for us. It's a very organized way to achieve quality, delivery, and cost objectives. And I'm proud to say that myself, my whole staff, we're Green Belt certified or higher. All plant managers are Green Belt or higher, and we're running over 500 projects a year, Kaizen events and Lean Six Sigma events. It is our culture, and our goal is to achieve leading financial outcomes from our sales, to have 38 to 40% gross margins, 19 to 20%, 21% EBITDA, and 21 to 23% working capital levels. I also would like to talk about a very important third objective, and that is to reduce our leverage. We have a lot of debt for a company our size, and we have short-term, mid-term, and long-term goals to pay down that debt. Short-term goals are to be annually free cash flow generative. We were in 2016. We've set goals also to do that in 2017. Midterm, we'd like to pay down $100 million of debt. And long-term, we'd like our leverage to be 3 times or less. Leverage, the ratio that I'm using here is enterprise value as a ratio to EBITDA. And we're well along the path of doing that. You can see that in 2016, we paid down we had $23 million of free cash flow versus our $100 million goal. We'd like to pay down $100 million debt over 4 years. You can see what our debt levels are today. We're committed to paying down that $100 million and keep going until we get to 3 times leverage. Also this year in 2017, we have some very important new projects that are coming online. First is debottlenecking some of the key new products that we've introduced and have done well in the markets. Second is the forming fabric plant startup in China, which I mentioned. And the next is the Chile plant startup, which I mentioned, also the new rolls plant in Santiago, Chile. I want to talk for a moment about debottlenecking of our new products. Many of them are being made in our largest plant. It's our oldest plant. Our company is 204 years old, and our business started in that plant. We still have our first plant over 200 years later. It's a great plant. Europe's really important. There's over 2,000 machines in Europe. It's the second largest market in the world behind China. It's a very large market. Our goal is to be number 1 or 2 in that market, and we continue to upgrade our products and expand our products. And you can also see in this graphic that we have other plants in the European area to service all the companies that do business there. And I'm proud to say that this operation is planned to start up in Q2. I mentioned Chile. I want to talk about that for a moment. It's a big growth market. You might think Chile, wow, that's a really small country. That seems to be a small thing you're doing. It really isn't. For our industry, it is a main hub for the world. There's a lot of big companies, big mills in that part of the world. It has to do with the fast-growing tree sources that are in the area, and they export their wood chips around the world that are used in mills around the world to convert and make cardboard, tissue paper, and all the products that come in our industry. And we are building a plant in the region, and that plant will be there for many, many, many years, and I'm proud to say that it's underway and on track. So stepping back for a moment, I want to talk about 2017. As an investor, what should you expect? You should expect the market environment that we serve to continue to improve. Our revenue is now aligned with a bigger portion of the growth markets than it ever has been before, and we will continue to advance that this year. A key metric is new wins, as I mentioned, and we report on that. There are evidence of new wins on new machines from the new projects that we install. We do expect new machine startups to outpace old machine closures on a go-forward basis, and it has this year to date. Brazil's a big deal to us. We have a big business in Brazil. It's a big industry in our markets that we serve. They've been in a recession. They started a recession in 2014. They started to come out of that. It really impacted our financials in 2016. It was the largest reason in 2016 why we had negative performance, and we expect performance to improve, and in fact it has year to date. Secondly, we do expect our business growth to continue to increase. As we install our machines, as these new facilities ramp up, we are tying and matching to them new business wins that we make proposals on in relation to the output capacity of the plants as we gear them up. And we're proud to say that we're on track with doing that, and evidence of that is backlog. And our backlog has continued to grow and is looking good headed into Q2 as well. We'll report our results on Q1 shortly. I'd like you to view those results on May 1. We talk about our results at 5 p.m. But I can tell you that in Q2, we're already headed in, we're in that quarter now, and we have a good backlog in this quarter. And lastly, free cash flow and debt pay down. We have a goal to have similar cash flow to last year, and we're on track to do that. A couple comments about our stock, mainly held by institutional investors. Insiders have about 18% of the stock. That's a lot. I'm the largest insider holder too. We're just beginning a retail investor outreach here with RedChip. We're very proud to do that, just in our second month of doing it. Our enterprise value is at a discount to the market and our peers. One of the biggest reasons has been this repositioning program, which took some money to do, and the aggregate level of our debt. I believe that as evidence shows itself, that we are in fact growing our sales and getting the bottom line results that come from that, and the cash flow that comes from that, and paying down our debt, that we will see a correction in our multiple. We do have high margins, as does our one other public comparable, Albany, and you will see that we expect to maintain high margins as we go through this battle, just as they do and just as we have. So let me just summarize this together as an investment thesis for you. We have passed through a tough business cycle that had many machine closures from declining grades of paper and a very strong dollar. We report our results in US dollars, and yet most of our business is not earned in US dollars. And as the dollar has gone up to peak values here, it has had a negative optical effect on our results, as we've lost in the translation, if you will, to US dollars. Consensus is that the dollar will stay strong, but also that the market will continue to look better on a go-forward basis. So I think the worst is behind us. I think it's in the rearview mirror. Secondly, we implemented a large repositioning program while going through that tough cycle in the industry, and it's done. We finished it. We finished it at the beginning of 16. We have more parts to the puzzle that will continue to happen over the next few years, but the financial big part of it is behind us, and we are committed to deleveraging and paying down our debt, paying down $100 million of debt. Roughly speaking, our equity account is worth about $100 million today, and paying down $100 million roughly doubles the value of our equity with just that one move. And last, I'd like to tell you how the quarter's going and this year's going so far. I'm proud to say that Q1 has started off stronger than we expected. It's been a very good, strong start to the year. We do have high leverage for incremental sales. As you know, our gross margins are 40%, but our variable contribution margins are 60%. So for $1 million of incremental sales, we get $600,000 of profit dropping through. And so it's been nice to have a good start to the year. Orders, sales, production, costs, margins, EBITDA, our customers, prices, cash, and CapEx are all on track first quarter and headed into the second quarter. We have a great backlog of good business going into the second quarter. We're obviously in the middle of it now during this conference call. We do continue to have FX headwinds against the US dollar. We hedge a portion of it through JP Morgan through a very contemporary hedging program, but we are exposed somewhat. And there is negative currency exposure in the first quarter. Lastly, I took you through a couple of the programs we have underway. We have several years more of these programs to continue the feathering out and feathering in of the old business with the new business and moving machines as we need to keep our capacity in line. So sitting here today, I'm happy to report that our business is on track and the objectives that I've just walked you through are on track as well. With that, I'd like to thank you for listening. I have some supplemental information in this presentation that takes you through our sales by segment for last year and our EBITDA reconciliations for last year. But more than that, I would like to ask you to listen in on May 1. and listen as we walk through our first quarter results. So thank you for today. And with that, I'll open it up for questions.
Okay, we're now ready to open the line for our Q&A session with Xerium Technologies. The ticker symbol is XRM on the New York Stock Exchange. And with us today is CEO Harold Bevis. Welcome, Harold.
Thank you. Thanks for having me today.
Pleasure to have you here. A lot of great things going on with Xerium. I have quite a few investors interested to hear some updates from the company. Our first question, this investor would like to know a little bit more about the repositioning efforts that you completed, why you endeavored to do that, the status of it, and how it's impacting your new business wins going forward.
Sure. Thank you. Spending back, we had a disjointed correlation to the market on a go-forward basis, and we had too much capacity facing declining grades of paper production, specifically newspapers, directory papers, publication grades. And fundamentally what we did is we moved them to focus on serving two other types of paper production, that being cardboard shipping containers and tissue paper towels. And being aligned with the market was fundamentally the driver of our activities. We had 18 specific projects. We had to pace them and organize them and march through them. That's why it took about 3 years to do it, and completed it. And they were intended to drive completely our new wins program. So we needed to have open capacity tooled with products that were geared towards servicing customers that make those types of paper and cardboard and tissue. And then we started a pipeline program of how many proposals did we need to make with what type of hit rate in order to get the capacity fill rates that we needed. It's the reason why we went out the end of 2017 with a large backlog, and why we've continued to build our backlog. So it's very fundamental to our top line and bottom line objectives on a go-forward basis.
Our next question is actually regarding your free cash flow. This investor noticed it was a pretty good start in 2016 with your free cash flow generation. And they're wondering what the expectations maybe are going forward, and how that may impact your ability to pay down debt, your plans to pay down debt.
Sure. Well, while we were doing the repositioning, I did spend all of our free cash flow and then some, especially to build a plant in China. And we had articulated that when we got through that one-time phase, that we would then be able to dial it back and just focus on filling up the new capacity, as I mentioned in the last question. And so we started that last year, and we generated $23 million of free cash flow, and we're continuing along that basis. We are a positive cash flow generator. So it starts with our EBITDA, which is about $100 million. We have $44 million of interest expense, $10 million of cash interest, $3 million of pension funding, and then we have $8 million of maintenance capex. Any spending above and beyond that is discretionary. We've guided that we're going to spend around $17 million a year going forward, and that means, therefore, that we're going to do some discretionary projects to continue to feather in and grow our capacity in the growth grades on a go-forward basis. And therefore, we have, if you do that math with me, you have between $20 and $25 million a year, depending on what the U.S. dollar is doing. Most of our earnings are not in the United States, or outside the United States, and therefore the repatriation of those profit dollars matters a bit to us. And the dollar did strengthen a lot in the last couple of years. It made our reported earnings look like they were going down, but the biggest reason for the decline in the reported earnings was the dollar strengthening against virtually every currency in the world. And we're expecting to continue to have a high dollar on a go-forward basis. So our base plans are built around filling up our capacity, retaining the business that we already have, adding to it with the new capacity we've brought online in these 18 different projects, and then using our free cash flow to pay down debt. So we want to pay down $100 million of debt over a 4-year period. We have a lot of debt for the size of company that we are, even though we're able to service it. It still bothers a lot of investors, and therefore we are focused on paying it down. It bothers me too. I'm a large shareholder and recently bought stock in November at $6.05 a share. And I have my personal performance vesting provisions around my compensation tied to paying the debt down. So you can bet that we're going to pay down $100 million of debt and our whole management team is focused on that.
Very good. Thank you, Harold. And our next question, can you talk a little bit about how big the market opportunity for Xerium is in China? And you talk about how the company protects its IP when it's operating overseas in places like China and elsewhere.
Yeah, sure. The China market is huge for the industry we serve. They are Chinese manufacturers, and they're public over in that neck of the woods. It's 34% of the planet's 8,000 paper machines are in the country of China, 50% in Greater Asia. So it was really an imperative that we set up properly to win and grow and prosper in that area of the world. Specifically, the plant we built, we tooled it to make cardboard products. So we're servicing the container board shipping container, the Amazon Prime equivalent in China, which is called Taobao. So we're servicing the cardboard market in China, plain and simple, with that move. The second phase of that plant is to service tissue and other products, but we are not calling on the declining grades of paper, newspaper, and copy paper. So it's a pure play from the get-go. Regarding intellectual property, our machine clothing is where we have all of our patents, and that's the plant that we put in place in China, and we brought our IP portfolio there. The good news about what we do is, given that we are selling to large public companies, every competitor must state that they have clear intellectual property, and therefore the public companies that are there, they don't entertain business with anyone that doesn't have clear intellectual property. So it's a very mature market. It's been in place for 40 or 50 years. They've been putting paper machines in China for a long time. And we're the last guy there, if you will, with this plant that we built. But there's a mature industry for protecting intellectual property for the products that we make and sell to large public companies.
Very good. Thank you, Harold. And I guess in summary, just in the remaining few moments we have here, what's the key takeaway for investors? Why should they be interested in Xerium today?
There's a couple reasons why you should buy our stock. Number one is we're trading at a multiple discount to our peer group. It's because we went through a tough period in an industry that was going through a change, and at the same time we were spending a lot of money with a high debt load. That scared a lot of people. We ended it. We have growth capacity in place. You should expect on a go-forward basis for our sales to grow and our EBITDA to grow, and we've committed to pay down $100 million of debt. So there's two ways to win on this stock. One is to be successful, to grow and fill our capacity where we've put it in place. Number two is to pay down this debt. I believe we also will get a multiple expansion. We trade at 6.5 times enterprise value, and Albany, our public peers, is several turns above that. So this could be a multiple return on stock price of today. So I think it's a good time to look at our numbers, and we report our results on May 1st at 5 p.m. Listen in and see what you think. I think you'll be happy to hear what's happening with our company.
Very good, and we agree. Thank you very much, Harold, for joining us today and sharing the story. For our viewers, we were just speaking with Harold Bevis, the CEO of Xerium Technologies. The ticker symbol is XRM, and that trades again on the New York Stock Exchange, ticker symbol XRM. As Harold just mentioned, the earnings call for the first quarter will be coming up on May 1st at 5 p.m. Eastern. So check out the press release about that so you can get the dial-in number and definitely plan to participate in that.